This is Mike O'Connor, and today is July 7th. Actually, you know what? It's midnight. It's July 8th, 2013. I am a trend trader who loves the Chaikin Analytics for iPad platform. My goal is to trade along with you so that you can develop confidence enough in this tool to get you a free trial. And my upside here in all this is if you sign up for a free trial, they give me a little something back. But really, the reason I do this is, yeah, a couple of bucks is nice, but it is the money-making capability and the ability to share this and to collaborate with other traders. I'm a vet, but I don't come from the trading industry. I'm self-taught. I've been trading since 1994, and I will tell you that this platform has consolidated everything I know how to do well as a trader, put it on a portable device, and has turned what used to take hours and days into a few minutes every morning to make really intelligent trading decisions. Now, most days it means, especially for a trend following strategy, today's not the right day to trade. There's nothing to trade. And having a systematic software program like this one that basically takes all of the emotion and guesswork out of things, but certainly doesn't turn you into a robot. There's critical thinking involved. But having the ability to make decisions very quickly and then go on with the rest of your day, I can't tell you how powerful that is compared to poring over charts to make that perfect decision. So I'm not licensed. I won't give you trading advice. No tips. We're not going to elbow each other at the cocktail party and talk about Apple. We're just going to show and share a great systematic way to grow your portfolio and outperform the market, whether you're a high-risk, highly leveraged option trader or whether you're simply trying to manage your 401k or your IRA. You will love what this tool can do for you, and you'll never want to pay a management fee to a money manager again if you're self-directed. If you are a money manager, you're going to love how expert you can sound for each one of your clients, and you can manage a custom portfolio for each one. So this is not a black box. This is a solid tool for people who love trading and investing and know what they're doing. Okay, and there's a lot of information about this on the Chaikin Analytics webpage, but essentially, the more green you can make your portfolio using their proprietary power gauge rating, the better your performance is going to be. So ferreting out things that show red and emphasizing and entering things that show green on a systematic basis will produce returns of potentially several percentage points over the market in both bad markets and good. The rules that I'm going to follow for this system, and I'm going to paper trade this and keep a log. We've actually got some trades on right now, and I'll show you how we're doing. I like strong markets, strong sectors, the best sectors, the ones moving up within the market. And then in those sectors, the industry groups that are moving the most, that are attracting institutional money, and strong stocks, and really the industry groups and the stocks, and then obviously getting the timing right and making sure that you are entering in a risk-defined way that gives you more upside relative to the potential downside. That's a winning strategy no matter what tool set you are using. Chaikin Analytics will just help you be more confident, make decisions smarter and more systematically with less emotions. So before we get into this, I always start with the market analysis because that really does instruct my trading. I think this is very simple. We're going to look at 3 time frames. The very long term, just to remind ourselves that despite all the noise about rising interest rates lately, that we broke out of a significant sideways channel this year. And if you're a believer in technical analysis at all, that a channel break like that will usually produce significant gains. It will at least match the range of the previous channel. And so 5-10 years from now, we can expect to be sitting potentially a lot higher than we are today. So that's all. It's a bull market, and it could be a secular bull. In the context of what's happened since 2009, you can see we are in an uptrend, but that prices have drifted significantly away from a base trend line that the market seems to like to come back and retest, and we should be prepared for that to happen. Who knows when? My guess is that it will be somewhere above this line, but it's going to happen. And then finally, because we make our trading decisions on the daily charts, if I can look at the daily charts, and there they are, you can see that we've been in a very shorter term, weeks to months trend that's been upward since about mid-November, when the European crisis seemed to quiet and talk of the fiscal cliff seemed to get resolved. We've been trending up ever since until recently, when Ben Bernanke threatened to take the punch bowl away. And the market got jittery, and it did break a significant upward trending line. So my market posture is long-term bullish, and on the intermediate term, I'm more neutral, and I don't know whether the market is going to go up or down from here. We've got earnings ahead of us, and so I'm cautious. So all this means is my market analysis tells me that I'm going to take fewer bullish trades, and the ones I do take, I'm going to risk half what I would normally take when I have confidence that the long, intermediate, and short-term direction of the market are all headed in the same upward trajectory. Right now, I think there's a little bit of a disruption. The second most important thing is to look at your sectors within the stock market, because they're not all equal. And I like to look at sectors on a 6-month and 3-month basis, and I do that because the Chaikin analytics for iPad software, or really any trend trading system, 3 to 6 months is generally the sweet spot. While we'd like to ride trends for a year and not have to deal with short-term capital gains tax, that just, the market gives what the market gives you, and 3 to 6 months seems to be the sweet spot. So what we're going to do is we're going to look at the relative performance of all the little subsets of the economy and compare them to the performance of the overall market. All right, so we're not going to look at a chart of the S&P 500. We're going to look at how much further above or below each one of the sectors did. We'll start with a roughly 6-month look. And we'll see there are 3 sectors that really have been driving the bus. This is consumer cyclicals. Consumer discretionary is another way you'll sometimes refer to this. The ETF is XLY that tracks it. The second important sector is healthcare. It has been on a roll for half a year. It's actually been on a roll longer than that. But it has been significantly outperforming the market by over 8 percentage points. And 8 percentage points too for the discretionary or consumer cyclical, used interchangeably, by the way. And third is financials. That is another strong one where banks are potentially going to profit from the gap in interest rates. They can lend out money at a higher interest rate than what they borrow it for. Those are the 3 big ones on a 6-month basis. If we narrow the time frame down to 3 months, we'll notice that a couple of sectors fall off the map. Utilities got crushed. Healthcare is performing right about at the market average, so we'll still say that's overperforming based on its 6-month strength. Consumer discretionary again, or consumer cyclicals, used interchangeably, along with financials. So these are the 2 pawns that if you're going to find strong industry groups and the best stocks, this is where to look first, because this gives you the best chance for price appreciation, because the wind is already at your back. If the market picks up a little steam here, these guys should get the biggest juice. So we want to look for stocks in those groups. And really, that's all the work I do outside of the tool. The rest happens here. The most critical thing that I do is take advantage of the fact that Chaikin builds strength in lists from the bottom up. So it's looking at individual stocks, and then it will sum all the performance of individual stocks, however you cluster them, to kind of give you a snapshot of how well that group of stocks is doing. If you're a professional money manager and you run 30, 40, 50 different client trading strategies, this is where you'd put them all in. You'd have Mr. Jones' strategy and Mrs. Smith's strategy. And you can look and see how Mrs. Jones is doing relative to Mrs. Smith and make changes based on individual objectives. That's not how I'm going to use it here, but you could. What I've done is put all of the stocks in each of the major sectors of the economy as tracked by the ETF, the SPDR's ETFs that track various sectors of the economy. So you've got the overall S&P 500, which is the ETF called SPY or SPY. And then you have subsets, and that's what these are. So the XLV actually is a watch list I created of all of the stocks that are also in the ETF XLV. ETF is kind of like a mutual fund, but generally doesn't have an active fund manager. It's built against an index, and that's what we're trying to do here. So we have 40 or 50 healthcare stocks that have gone into the XLV watch list, or the ETF that tracks healthcare, and another 40 or 50 that go into the consumer discretionary or consumer cyclical ETF called XLY. Again, those 2 terms used interchangeably. and XLF is financials, XLI industrials, XLK technology, and so on. One of the things you'll notice is that this bottom-up ranking of sectors based on the underlying strength of each individual stock is not at all different from the relative past performance that we just looked at. So two different ways of measuring sector strength. There's what have the stock prices done the last 3 and 6 months, and what are they poised to do based on the series of fundamental and technical parameters that are in this Chaikin and analytics for iPad. And just as it stacks watch lists based on the quality of the underlying stocks, it will look at stocks and rank them based on the underlying quality of a number of different factors, from financial metrics and earnings performance, more of the kind of fundamental, how's the company driving profits, to price volume activity, which is all about institutions going into and out of shares at big volume. And then, of course, the expert opinions, and Mark Chaikin actually believes that analyst upgrade downgrades really drive stock price performance in a big way, and he believes that capturing this is kind of part of the secret sauce for the power gauge rating. So all of those factors are then coagulated and put together, and then the power gauge will give it a score. And we'll look at this is the A+ zone, and this is the D- zone here. So the more A+ you have in your portfolio, the better you're going to do. Get rid of the D+ students and bring more A+ students into your class. But again, the key is to do it when the market is moving, and that's why we focus on great sectors that are attracting institutional money and the industry groups within the sectors, so that we can capture the good fundamental data. Now, having done that, looking at the XLV watch list, which is my #1 rated watch list, and XLY and XLF, I was able to create, I guess I should put this back into slideshow mode. I bet you prefer that. Let's do this from current slide. I then get a watch list for each, or a bucket of stocks for each watch list that I've created. So for the top XLV stocks, or the healthcare sector, I've put in, as you can see, probably 40, 50 stocks here. And then the system will rank them hierarchically from very bullish to very bearish. And once again, it's the stuff in the upper left that we care about the most. You'll see the system also will then tell you on any given day, it will throw off a buy signal. Now there's a number of different buy signals, and they represent sort of the tendencies of different traders. It's not meant to urge you to blindly accept trading signals, but it's part of your decision making. So now you know which ponds to fish in, which fish to catch, and when to cast your line. That's basically what we're doing here. And then you can see we did the same thing for the XLY, or consumer discretionary, and the same thing again for financials, where we're ranking stocks from best to worst. And again, here at USB, we're talking about a neutrally rated stock in one of the top 3 sectors, and my guess is major banks is an okay to good industry group. So even the weak stuff here is better than 70% of the market. So you can see what you're doing. You're cherry picking. And then, of course, you're acting on buy signals that make sense for your risk tolerance and the way you like to trade. So there is a little bit of art that goes along with this. If you're kind of new to this, you could look at these trading signals as training wheels, but you do need to get educated about managing risk and things like that. I'll attempt to be the person to help you do that through these videos so you can learn how to do it for yourself. When you go through the watch lists of the 3 areas of strength in the market, and you look at the timing signals, we essentially boil things down to 6 potential stocks to trade on Monday, July 8th. There's one other thing that I like to check, which is, especially with earnings coming up, whenever you enter a single stock position, there's always something called headline risk. And some headline risk is unknown, like a CEO gets busted on accounting fraud or running a Ponzi scheme. Unless you have inside information, there's nothing you can do about that. But there is preventable headline risk, and one of them is earnings, right? Earnings will cause stocks to move. And while analysts make their best guess, and no doubt some people get information on the QT and have the ability to illegally profit, from either shorting or going bullish on the stock into earnings. We don't have that luxury. In fact, I don't want to trade anything within 30 days of earnings. Now, trend following strategies, you have to bake in earnings announcements as kind of part of the risk you're willing to accept. But usually I want to make sure that if I'm trading something on a trend bullishly, I want to give it a chance to work for a little bit before I face that known headline risk. Things can happen or evolve. Analysts can upgrade or downgrade stocks ahead of that earnings announcement. Or there could be some other catalyst like a FDA licenses a stock, or greenlights a drug for public use. But one of the things you can do is you can input this trading symbol here on this Yahoo Finance earnings calendar, So Sigma, for example, something I was interested in, has a buy signal. It's a great stock and an awesome on-fire industry group, medical insurance. But unfortunately, August 1st is earnings date. And I just plugged that in here and then it called it up here. And if you scroll down, it will actually tell you alphabetically when Sigma is going to trade. Let's see where that is. There it is. So you can see it's going to be before the market opens toward the end of August. So if you as an options trader looking for August expiration trades, I wouldn't take that. But in general, even if I'm just doing straight ahead stock, why introduce that risk so early on? So when I go through that process, and I've kind of done that, I've entered all of these into earnings, all great potential trading signals. The one that doesn't have that foreseeable headline risk is Meditronic. So let's focus in on Meditronic a little bit, because I want to show you a little bit about kind of how the system consolidates information. So first, over here, the power gauge, which represents 20 underlying fundamental and technical criteria. It's an algorithmic model that essentially composites all the research you would do and puts it in one place and then scores it. So this is very bullish, meaning it's in the top 1/5 of all stock ratings, and that's the upper quintile. It immediately eliminates 80% of the market. You're now dealing with the best of the best. In addition to that, its technical rating, which is essentially tracking institutional money flow into a stock and price action, suggesting the stock has been going up. The technicals look good on the stock. And it doesn't take a rocket scientist to see that there are. The first thing you'll see in the tool is or the thing that will stand out in the tool is an orange upward sloping line, or it should be upward sloping if you're considering trading it. This is a double exponential moving average on the 200-day. So most institutions will trade the 200-day as sort of a line in the sand. By double weighting it, it gives more emphasis to the first half of the average compared to the last half. So it'll move faster than the regular 200-day moving average, but it will also be incredibly smooth. So you won't have whipsaws. And in general, one of the first things I'll tell you is looking at a chart, never consider any stock ever for a bullish trade unless the orange line is pointed up. It doesn't have to be pointed straight up or even at a 45-degree angle. It could be at a 10-degree angle. But if that thing is curving or sloping down, it means that there's a possible trend change. Why are you risking your capital there when there's so many other stocks that will have an orange line up? That's rule number one. Rule number two is these dotted channels you see, or actually there's 3 lines here. There's one you can't see. It's hard to demo an app when on a forum like this because I'm not on my iPad. But that middle dotted line is a 21-day moving average. So that's going to be your short-term triggering trade entry event for a lot of the Chaikin systems. And so you have to pay attention to that. I'm going to show you how this particular buy works in a second, all right? So again, I think there's no reason not to require, unless you're a value trader or you're somebody who likes to catch bottoms and you have kind of a system for getting out. If that 21-day moving average is not above the orange moving average, and if it too isn't like pointing up, almost like railroad tracks, then why take the trade because there's others to take? Now that's a little bit discretionary because there are times where the stock could pull down hard but still be in an uptrend. Like here's a good example. You can see the channel is pointing down, and there was an entry signal here, but by the time that entry signal happened, you can see the channel line was even moving up. So orange line up, and the dotted middle line, or the 21-day exponential moving average, up, okay? Down here, you have the classic Chaikin money flow. This simply tells you that a stock is under accumulation or distribution. If you see a lot of green for a few months leading up to your trade decision, that means that the wind is at your back. Conversely, if you see a lot of red, the wind is not at your back, and that while you may be buying into institutional liquidation of the stock. This is not a good triggering signal. In other words, when money flow goes from green or red to green, take the trade. It doesn't really work that way. Okay, this one is about money movement over a period of time. So look at it as sort of a confirmation signal. And then finally, before you get down to the power gauge, which is now dynamic, by the way, you can now track how the power gauge changes color. But relative strength is simply a measure of how well this stock is performing relative to the S&P 500 on a 6-month basis. So if it's extremely outperforming, meaning the rate of return over 6 months is in the upper 25% of all stocks that are ranked against the S&P, this indicator will turn green. If it's at 50%, meaning it's in the top half of stocks that are performing against the S&P, it will be yellow. So obviously, green is your friend on all of these metrics. And then, of course, you're able to look at the fundamental ratings if there are certain ratios or things, percentages or things like that are important to you. Relative strength against the industry group. A lot of that information is found just by toggling on this information below the power gauge. So that may be a lot. Let me get into the trading signal that's represented here, and one that I like to take. This is what would be the equivalent of a pullback trade. But they call it a relative strength buy. One of the conditions, interestingly enough, is that the stock does not have to have a bullish power gauge rating. The idea here is if there is ever a signal where you're going to catch something early, this would be the one, and they say there's so many other indicators that have to be strong that it's okay if power gauge is neutral. It means that the analyst just hasn't upgraded the stock yet, and it's a matter of time. But I just like to, why not? Why not throw in that other rule that's not here that says, I don't trade bullishly unless this line is green. I just don't see a reason to do that. And frankly, I prefer very bullish stocks. But I also don't want to chase very bullish stocks that have been overperforming. So the other rules are important here. One is we talked about a stock crossing over its short-term trend. What they mean by that is that 21-day moving average. So again, going back to Meditronic, the stock pulled down, it's really hard to see, and then crossed above it in the last trading day, making this signal valid for today. So stock above 21-day exponential moving average. In this case, it looks like it crossed below it for maybe a day and then bounced back up, triggering the signal. But the other events that must be true, and these are critical here for this signal, is that because you don't want to get into a stock that is about to roll over or is about to or is so overbought, you're going to eat a lot of dollars before it starts moving in your direction again. And that would be their overbought, oversold oscillator is rising. And while they don't say it here, rising from its low point would be the critical thing. The Chaikin overbought, oversold indicator is like a MACD or a stochastic. It's actually kind of a combo platter. So think of this one as a combination of momentum and overbought, oversold indicator. So it's like an RSI and a MACD rolled into one. For those of you who don't know what the heck I'm talking about, it's trader gibberish. Know that the best time to take this trade, you can see this oscillator is tuned to price action. And so what it's suggesting is that when you get a pull down below this low band, which is the 30 level, you're in oversold territory, but that's not a triggering. That doesn't trigger the trade. It must be rolling up. All right, so momentum needs to have descended, and then new momentum. That doesn't always work this way. You can see it can fail, but more often than not, when you see the curve, it coincides with a bounce, pullback, pullback followed by a bounce. So if you're a bounce trader, you know what I'm talking about. But essentially, crossing above the 21-day exponential moving average with this rolling up from oversold territory. And the final piece, which is critical here, they're going to say that relative strength must be good. So this is a relative strength bias. So you don't need money flow, but you need relative strength, meaning the stock has to have outperformed the market. And that simply adds to your confidence that, the old saying is that trade the trend because the highest probability in a trend trade is the direction that the stock has been going in. Well, if you have relative outperformance already in the bank and the stock has simply pulled back and the oscillator is suggesting that momentum is starting to kick back in, well, then that's the time to sort of buy the stock at its relative low point for this cycle. Okay, so it's really, I think, a bounce trade. But those are the key ingredients, and I love trades like that. They're great for establishing a put option for the month of August, and that's probably how I'll trade this. But let me kind of show you, how, my rules for trading something like this. If I can go over here, I think I've got my paper trading journal out here. Yes, I do. And I've already done this. My simple rule for this bullish series of stock trades that I'm going to take and track in real time, so you can see how good this does, or how bad a trader I am, is that our rules are going to be, and I think the portfolio size is actually a little bit bigger than this. I may have screwed this up. I think it's about 100,000. Let's pretend it's 75,000 for now. Oh, I'm sorry, that's the puts. It is yeah, I've got it at 75,000, but I'll change this to 100. So I enter the symbol. I pull the price in from Google. It's about at 52 bucks. I enter a support rating, which is kind of a important recent low. If you're not a technical trader, really that doesn't matter as much. Let me go to MDT on this chart real quick, so we're all on the same page. But the support line that I'll use, or I'll draw, MDT. Sorry, if you're still with me on this recording, I appreciate it. Most of you have thankfully bailed. You're not hearing me. You can see there's kind of a nice little line right here. And the theory is, if you're new to trading, is that the more touches you get on this line, the more likely it is to hold, especially for a strongly rated stock that's in an upward trend that had a bit of a consolidation pattern. The probability is that this stock will break to the upside and keep running, but if it doesn't, you draw your line in the sand here and then set a stop loss a few percentage points below that, and that's basically risk management 101, and that's what I'm doing here. So when I go into this, I will be better prepared to show you how to take a trade here. But Meditronic is the one I like, and I'm going to buy, my portfolio is 75,000 strong. My rule is that I do not want more than 10% of my portfolio to be in any one stock. 10% is my rule, so the most we'll buy is $7,500 worth of Meditronic. So I kind of check my position size in two different ways, and then I take whatever is the lower amount. So I might, when I do the analysis, saying that if I limit myself to $10,000 in my portfolio, I simply divide 10,000 by my entry price of $52.41, and I'll come up with 144 shares. So that's kind of one approach. The other approach is to say that I am going to buy as many shares as it takes, so that if the trade were to go against me, I would lose no more than 1% of my portfolio. And the way I figure that is I've got my entry price of $52.41, right? And then I told you where I thought the support level was, and that I would place the stop a little bit below that support level. For me, a good line in the sand is if the stock crosses below $50.30, I'm out. So I would be in at $52.41 and out at $50.30, which is really that's very tight. In fact, for this exercise, that is a little too tight. I'll say 3%. Willing to ride the stock 3% below my support line. So if I enter at $52.41 and my stop loss is not working, guess I'm not going to be showing you trading risk management today. It's too late, and I'll stick to one and I'll figure out why this isn't working. But essentially what you would do is take the difference between the entry price and your line in the sand price. Let's, for argument's sake, call it 50 bucks, which means you'd have $2.41 per share of risk. If you're willing to lose up to 1% of your trading portfolio, that's 750 bucks. If you've got $2.50 worth of risk, give or take, it means that you could afford to buy about 300 shares. The problem is if you bought 300 shares, you'd be well above your portfolio limit of no more than 144 shares, or $10,000. So if this formula were working correctly, it would still point me to this position size. The bottom line is 1/10 of my trading portfolio in Meditronic tomorrow, provided the the market doesn't do something crazy, is what I'll enter in on a paper trade. Now, for a naked put, which is a strategy that gives you the ability to get the same stock at a discount, if you're willing to assume some additional risk, that's really what the strategy is, and it's one I prefer. I'll actually be selling the $52.50 strike for August for a premium of $1.35. With the current price being at, what did we say it was? It's at currently at $52.41. If I'm willing to buy the stock essentially at $52.50, and the stock is trading at $52.41, but somebody's going to pay me $1.35 for that privilege, that means that if I do end up buying the stock would have to close below $52.50 August expiration for me to own it, but that I would be paid $1.35 to buy the stock in a month, and my actual price would be the difference between the strike that I sold, which was $52.50, saying I will take 100 shares of this stock off your hands for $52.50, provided you give me a premium of $1.35. So I would subtract $1.35 from $52.50, and that would be my cost basis, something like $50.85, doing it off the top of my head. So why would you buy a stock at full price when I can buy it for $2 later, I believe, or $2 less? I believe fundamentally that the stock is going to go up. The Chaikin power gauge has told me so. And if the stock doesn't actually pull down and I'm not able to buy the stock at a mutually agreed upon price in the future, the worst thing that happens is I keep my insurance premium of $135 times the number of contracts that I'm willing to accept. So that was probably a lot of gibberish if you've never traded options. If you've never traded options, though, and you are a buyer of long stock, I can't think of a better thing for you to learn as quickly as possible because of the amount that you'll be able to reduce the cost of your trading over time. It's a wonderful strategy. But really, it's about the Chaikin analytics for iPad. I hope that my long-winded 7 minutes, sorry about that, diatribe about how to use this was helpful to you. And I would love your feedback because remember, this is what we're after. So click the link at the top of my Facebook page, get yourself a free trial, and let's trade together. Thanks a lot, and I will try to make the next video like about 3/4 shorter. Thanks.